Okay, quickly, we're going to go into partnerships. I don't want to go into too much detail about JVs because you really need good legal advice on this. That's all I can say. Get a lawyer who has experience in JVs. But really, there's two general reasons to get involved with JVs. One is to bring on liquidity after a deal is done. As we know, real estate is illiquid, and we may want some liquidity, but don't want to sell. So the option then is a HELOC or refinance, but another option is bringing on a JV partner. Number two is to bring liquidity before a deal closes. So on my sixplex example that I talked about above, we brought on 200,000 of JV money for 20% ownership in the deal, and that gave us all that initial capital upfront to have a sort of funds for the construction float as we were building. So some pros and cons. So you're giving up equity in your project for capital, but there's a whole bunch of ways to structure this, and this is really a pro. You can, you can structure a JV agreement in 100 different ways. You can have a private JV loan. You can have equity and cash flow JV. You can have a preferred return, and the list goes on. So really, the best practices here are lawyer, lawyer, lawyer. And another one that I've learned the hard way is make sure your JV partners are aware of your long-term and short-term strategy for their money. Make sure they know how long their money is going to be tied up for, because they may have different goals than you for their funds. And I'll toss it over to Whitney for syndication.
All right, guys, I got a little fat fingered on the buttons here, so I'll just pop up these considerations and best practices real fast so you guys can take a look at it.
Sorry, I think I whipped through that quickly.
You did. I was having trouble keeping up with you, and then I went the wrong direction.
I was looking at the time.
All right. So, so Brad just recapped joint ventures, and we're going to talk about a little bit about syndications. And so syndications, let's just think of it as a joint venture scaled up. All right. So a syndication, for those of you who don't know what the definition is, it means a group, quite simply. So, but in most syndication deals, there's actually two groups. There's the general partnership group and the limited partnership group. So I'm going to go really quickly through both groups here. So right now we're talking about the limited partnership. Okay, the limited partnership are generally the part of the group that is bringing the down payment and the capital expenditures to a deal. As a limited partner, this means you can create truly passive income because you are leveraging operators' time, knowledge, expertise, credit, other investors' money. It's a beautiful place to be. However, you do need to take the time to learn how to vet a sponsor, vet a market, and vet a deal. And this is very different than single-family investing, where a lot of people vet the deal in the market that's in their backyard and then turn around and place it with a property manager. We're actually doing it reverse because you're investing in a business. Okay, it's an active business. But the cool thing is you get to leverage tons of money. Okay, now it does require about 25 to 50K to get started. And this is kind of cool because you can actually put large chunks of money to work. But this is not for somebody who only has $50,000 in the bank. Okay. But once you vet and fund your deal, the income is truly passive. Now, with all of our investment strategies, make sure you got a solid financial foundation and you've got your own reserves taken care of. And you may not be able to recycle funds nearly as quickly as you can with other strategies. However, there is a syndication out there called value add. Okay, not a development. We're not doing ground up construction, but value add, where essentially we're taking a multifamily building, we're buying it below value, pushing it to market rents through 3 different strategies, and then refinancing out our capital at about 2 to 3 years. And then we'll recycle it and do the next deal again. So it can be an extremely powerful strategy. But experience-wise, as a limited partner, you just need to be able to make that initial investment, choose the right operator, market in the deal in that order, and then you get to leverage the operator for the day-to-day operations, okay? It's not you, it's them. Now, for some considerations for the limited partnership, are you comfortable having your capital invested for 5 to 10 years, okay? It takes about 2 to 3 years to rehab the project and maybe another 1 to 2 to 3 years to sell the project. So it can actually, your capital can be invested for quite a long time. And there's also the difference between being an accredited and sophisticated investor. When we get to projects of this scale, we're bringing in the Security and Exchange Commission. And so we operate under the Regulation D, 506 ruling for accredited only investors, and then 506B ruling for sophisticated investors. This is why a lot of sophisticated investors I talk to, they're like, I don't know where the operators are. Well, because if they're operating under a 506B ruling, they can't solicit investors. So it's really tricky. So this is my number one piece of advice for you. Syndications is something that you want to do. Network, 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 network to find those operators. Now, on the general partnership, okay, these are the people that are actively running the business, okay, on behalf of the limited partners. It's super time intensive. But yay, it's super time intensive, and you get rewarded with the money on the back end of the deal because you get to employ other investors' money. You'll probably want to invest alongside your investor to create alignment, but you actually are taking on the highest reward, the highest risk, and also get the highest rewards. Okay, and then experience. You need to have a ton of experience because not only are you managing a large asset, you're managing other people's money. Okay, so you definitely want to make sure that you have the experience. Somebody on your team has a lot of experience as well. All right. So considerations for a general partnership, simply, do you know what you're doing? Okay, if not, you need to invest a large amount of time in your knowledge and expertise to acquire the asset, acquire the investor, and get a solid background behind you.